Hello, in this video we'll continue our gross income problem set. This is problem 14. Mango rents a house from Coconut for $2,000 per month. Mango starts the lease on December 1st, year 1. Mango pays Coconut 1 year's rent in advance on December 1st. Coconut is a calendar year taxpayer. So we're looking at whether there's gross income here in this respective transaction. And there's really two parties, Mango and Coconut. Now, whenever we're dealing with income tax, we always have 5 questions. What amount of gross income, if any? What amount of deductions or credits, if any? And those are the inflow and outflow questions. When, who, and then what is the character of the items? So we're focusing on gross income. So really, we're looking at what amount of gross income, if any, when, and who. That's really what we're focusing on. Now, Mango is renting out the house, so Mango is the one paying with respect to these items. Coconut is receiving payment with respect to these items. So since we're dealing with gross income and inflows, we're focusing our questions here, or our analysis, on Coconut. When, this is interesting because we're dealing with a lease that starts on December 1st, year 1, and Mango is paying Coconut 1 year's rent. So this involves both year 1 and year 2. And it's possible that Coconut could have some gross income in year 1, can have some gross income year 2, 1 year, the other year. There's all different type of possibilities, and we'll talk about that. So first thing we need to do is we need to figure out, do we have gross income here? And again, to define gross income, we start in section 61 of the Internal Revenue Code, which says that gross income is income from whatever source derived. So it's a very broad definition. From there, we go to the Supreme Court jurisprudence, and we see that in Glenshaw Glass, the court states that gross income is any income where the taxpayer has an undeniable accession to wealth, that is, which means that the net worth has gone up, and net worth is assets minus liabilities, and it's been clearly realized. So there's a realization element, which realization deals with severance or separable event from the actual property or activity that created the actual income. And then there has to be no strings attached, which means that there's complete dominion and control. So no strings attached on the actual inflow of the income. So holding aside, again, the when question, we already know Coconut is who's at issue. Holding aside the when question, years 1 and 2, looking at both years 1 and 2, just to see if there's any gross income for both years in total, right? Because if you're looking at years 1 and 2, because it starts in year 1, right, and it goes out, like, let's do a little timeline, right? Month 1 is where years 1 and year 2 end. So this is 12/1, year 1, right? And then we have 12/31, the end of the year, and it goes all the way until November 30th of year 2. And this is year 2. And Mango and Coconut, we're told Coconut is a calendar year taxpayer. Mango is probably a calendar year taxpayer as well. So that means that Coconut is going to report income from January 1st, year 1 to December 31st, year 1 on the year 1 tax return, and then January 1st, year 2 until December 31st, year 2 tax return. So that is going to become an issue we're going to have to talk about. But before we get to that, let's make sure we even have income. Looking in total, looking at the total period of time, let's see if we have income. So our net worth has gone up because before this lease, there was no rent. After the lease, when it's ended, has net worth gone up? Yes. Coconut receives cash of $2,000 per month. Realization. Do we have realization? Well, Coconut owns the house, and then you can separate the house from the actual rent that came off the house. So we do have severance. And then finally, dominion control. Are there any restrictions on the actual property, the money that's being received? No, there's no restrictions, so therefore there's full dominion control. So now we determined that we have gross income, and before we look at the amount of gross income, right, there's going to be some inclusion in year 1, year 2, combination, one of the years, whatever it is, okay? There is going to be inclusion in gross income because Coconut meets the Glenshaw Glass requirements, and I'm telling you right now, there's no exclusions for rent. You're going to learn more about exclusions later on, but there's no exclusions here. So now the question becomes, okay, we have inclusion in gross income, but when? When? again, our possibilities are we could have year 1 and year 2, or we could just have year 1 or just year 2. So we have really 3 possibilities. Because we do have gross income, we just determined that. So now the question becomes, when is it gross income? So really, we're not told in the fact pattern, but what is the, when you look at the when question of when it has to be recorded, you have to look at the method of accounting with respect to the taxpayer. The method of accounting with respect to the taxpayer from a tax standpoint, not the financial accounting method of accounting, the tax. And there is some overlap between financial accounting and the tax method of accounting in terms of idea, but there are also some differences, and that's why it's important to understand that it's important to highlight those differences. So there's there's actually more than 2, but there's 2 main methods. There's the cash method, and there's the accrual method. So the cash method says that regardless of the circumstances, you include, we're talking about inclusion here. We're not going to talk about deductions in this problem because we're talking about gross income. So you include the gross income when received. And I want to talk here, because we don't know what Coconut's method of accounting is, I'm going to go through both of these, the cash and the accrual method. And there's also the hybrid method. We're going to talk about the cash and the accrual because the hybrid is a combination of both. So the cash method, we include gross income when it's received. Well, if we apply the cash method, so under the cash method, all rent for the entire rental agreement, all 12 months. So that's $2,000 per month times 12 months. That's $24,000. All $24,000 is recorded in year 1. In year 1, if it's the cash method. $24,000 of gross income to Coconut under the cash method. Under the cash method. Now that's under the cash method. So it's pretty clear if Coconut was a cash method taxpayer, which if Coconut's an individual, it's very likely Coconut is a calendar year cash method taxpayer. Could be accrual method though. So we do have to go through the accrual method analysis as well, which I'm going to talk about next. But I want to highlight, if Coconut is cash method taxpayer, then it'll be $24,000 of gross income in year 1. That's year 1 right there. Right there, year 1. Okay? So $24,000 gross income year 1. So it's the entire life of the agreement, even though it takes place over year 1 and year 2. That's how the cash method works. You include gross income when it's received, regardless of those circumstances. The accrual method is similar to the accrual method in accounting with some limitations and some special rules, but the accrual method includes, and this is a general rule, it includes gross income of inflows as it's earned. As it's earned. And the idea here is Coconut doesn't earn this income from a financial standpoint until it's actually performed, until Coconut actually makes this property available for rent to Mango. So you would earn on a monthly basis as you go. So this is under financial accounting accrual. If we applied a purely financial accounting accrual method, which again, we include the income as it's earned, in year 1, we'd have $2,000, and then in year 2, we would have the remaining 11 months, numbers 2 through 12, which is 11, times 2,000, so 22,000 would be in year 2. So if we were applying a financial accounting accrual method, we would have number 1 here, year 1 would have $2,000 for the first month, and then the remaining 11 months would be year 2, so 22,000, which equals a total of 24,000, but it's broken over the 2 years. So that's one thing right there to understand under the financial accounting. But this is tax. Tax starts off with the general rule saying that we also include gross income as it's earned, but with respect to prepayments, when you prepay items, when you prepay income, like we have here, generally speaking, it has to be included. It has to be included. And rent is one of those items. There's a few things like rent, warranties, where there is no exception to this rule, but rent has to be included. Now, if it's like a construction contract where it's paid in advance, there's actually some special rules, 2 special rules that say that if it can be completed within 1 year from the date that it starts, then you can actually elect to take it over, basically do the financial accounting approach over year 1 and year 2. And there's another exception as well, which if it can be, there actually hasn't been performance until later on in year 2, then you can do that, or you can isolate it to those years. But for rent and like warranties as well, there is no exception. So when you have prepayments of rent, like Coconut has here, it all has to be included in year 1 as well. So it's the same. It's the same treatment, $24,000 of gross income in year 1 under the accrual method as well. Under the accrual method as well. So it's the same result to Coconut here. $24,000 and $24,000 in year 1. Only in year 1. So nothing in year 2 under our tax definition. Only in year 1. So we don't worry about this possibility and this possibility. It's possibility 2 where everything is in year 1, all $24,000, even though it actually occurs over year 1 and year 2. Now you might be saying, why does this make a difference? For some taxpayers, it might not. But other taxpayers, they might have some carrybacks they cannot utilize in year 1, or they might be in different tax brackets in multiple years. Maybe in year 1, this taxpayer is in a lot higher tax bracket because they're going to retire in year 2 and be in a much lower tax bracket. Year 1, they're still working. They retire in year 2 in a lower tax bracket in year 2. So you might want to extend that out. Also, in tax, we always want to defer. We always want to defer income because of time value of money. Timing is a huge deal. When it comes to income recognition, we always want to defer in general because paying this money, paying tax on this $24,000, right? If you're paying at a 33% rate for federal income tax purpose, 1/3, you'd be paying $8,000 of tax on this gross income in year 1. Versus if you paid the $24,000 in year 2, you would be able to extend that until the end of year 2 when you pay it, and you could use that $8,000, you can invest it, and you can make some money off it. So from a tax standpoint, time value of money, we always want to defer income. Always want to defer. And there's a few exceptions. I say almost always. Sometimes we don't want to if we know rates are going to change based on the political landscape, or again, if based on the taxpayer, or if there's some type of carryback that we need to utilize in right now. Now, for you're going to learn later on that when we have outflows, credits, and deductions, we want to accelerate for the same reason of time value of money. If we can get those benefits today and get that money today, it's time value of money. $1 today is worth more than $1 in the future, and that's the idea of time value of money. Time value of money, $1 today is greater than $1 in the future. And the idea is that with the opportunity costs involved, you can take that $1 today and you can use it to invest or do other things with it, versus if you get $1 a year from now, that's not worth the same. And this is holding aside inflation and those kind of things. This is saying, okay, well, you could have that money today and you could use that in various ways. So I hope this helps you understand. Again, the main summary here is the when question. And again, when it comes to the cash method, we include when it's received, regardless. When it's accrual method, we include the gross income as it's earned, but for prepayments, the general rule is we have to include when we receive it, with a few exceptions, but for rent, those exceptions do not apply. And again, when you're dealing with timing, we want to defer income as long as possible, and then we want to accelerate the deductions and credits. And the reason is, again, $1 today is worth $1 more in the future. So if you can save $1 today, that's and pay it in the future, that's better than having to pay it today and then not pay it in the future.